Hi, everyone. Welcome to our live workshop. Thank you so much for joining us today. My name is Julia Gable, and I am a Strategic Account Manager here at Refinitiv. Before we begin, I'd like to cover a few housekeeping items. There's no dial-in number for audio, so please use your device sound and plug in your headphones to listen to the workshop. If the slides are stuck, please refresh your browser at the bottom of your audience console screen. You can expand your slide window by clicking on the maximize icon on the top right of the window or by dragging the bottom right corner of the slide area to expand it. Please note microphones are muted. Please submit your questions to the speakers in the Q&A box. We will answer these at the end of the workshop. And finally, the link to the recorded webcast will be emailed to you after the conclusion of the event. And you can find the slides along with other useful links in the resources section. Today, we are going to focus on the psychology of business and how media sentiment and human biases directly impact business and investor performance. As we all know, we've been experiencing extreme uncertainty across the globe in terms of financial, political, and medical stability. That uncertainty can be directly correlated to affecting the economy. As a former journalist myself, I can attest to the fact that one of the best barometers for human behavior is the media information flow. With an almost infinite amount of news articles and social media posts swirling today, we have the ability to quantitatively observe how human sentiment influences financial markets. I am pleased to introduce Dr. Richard Peterson, CEO and founder of the MarketPsych brand. He leads MarketPsych's data and asset management divisions and has trained thousands of professionals globally to leverage behavioral insights. Dr. Peterson is also a board-certified psychiatrist. Dr. Peterson, over to you.
Great. Thanks, Julia. And happy to meet everyone today, this morning, virtually. Today, we'll be talking about biases that we have in our judgment and decision-making and ways that we can iron out those and improve our performance in the business world. But we'll also be talking a bit about how those biases play out in the public markets. So we have biases that are based on emotions, biases that are based on how we think. These are mistakes that we all make. And at the same time that we have these mistakes, there's also tools and techniques we can use to improve our performance, both by overcoming biases, but also by playing to certain strengths that we have in our own decision-making. So we'll look at evidence for both the biases' existence, how they affect public markets, and then what we can do to overcome them. Great. So the first slide here is a visual illusion. And you have a quote here from Dan Ariely. If you look at the middle of the visual illusion and stare at those dots in the middle, you should see a little shimmy. The dots will move slightly as you stare at them. And yet the area around the dots doesn't move. And the reason that there's a movement there is that our brain is actually designed to see vertical lines like tree trunks and horizontal lines like the horizon. The visual cortex has separate cells for each of those. So yet, when we look at something that's round or somewhat fuzzy, we're unable to distinguish between the vertical and the horizontal. And so our brain switches between those two systems, and we get the shimmy effect. The same thing is true when we look at risk, business risk. Sometimes we see opportunity, and sometimes we see danger. So obviously, with the beginning of COVID, many people saw danger, and markets plummeted. But then somehow there was a reemergence of a sense of possibility, that maybe the stimulus, maybe the low interest rates would lead to more opportunity. And so the framing changed. But while the framing changed in the financial markets, for many people in the business world, that has remained. This uncertainty has remained. And we still see this fuzziness. Sometimes it feels like opportunity. Sometimes it feels like danger. And it really depends in some ways on what sector you're in and what industry as to whether we're in one mindset or the other. And that's creating a very strange feeling, I think, in the business world, a sense of a bit of chaos around, what is going to succeed, what is not doing well. We probably all know some people who are doing very well in their businesses and others that are suffering and having a really hard time. And so this difference, this schism, is creating a sort of a schizophrenic sense of what is happening in the business world. So I'm looking at the brain imaging slide now. So the reason that we have these effects in our business thinking is because we have two systems in our brain that govern whether we pursue risk as an opportunity, which is called the reward system and is depicted in the left image, or whether we see it as a risk. Now, One thing that's an interesting effect of this is when we see an opportunity as something we should go forward to, we actually turn off our ability to detect threat. And so in the brain image to the right, what you see is this fire, this flare up in someone's willingness to take a business opportunity. But to the sides in the little blue dots, what you see there is the deactivation of the threat detection area of the brain. So as somebody's excited to take a risk, they actually lose the ability to see danger. So not only do we have these two systems, but they offset each other. When we see an opportunity, we lose the ability to detect any flaws or danger in our reasoning. And this is one of the key biases we run into. When we become committed to something, we often stay committed to it too long, even when danger emerges or when evidence emerges that maybe we made a bad decision, we tend to stay committed. And that is good in something like a long-term relationship with a partner, because there can be ups and downs, but that's not necessarily good in something like a business scenario. And so it's important to understand the context and the functions of the brain that can interfere. Now, one of the most common ones has to do with emotion, and this is called emotional priming. Now, there's two faces on this screen. One is smiling and is friendly, and one is giving you a kind of a negative look. And those two faces, it turns out, actually create a different feeling in you, and not only a different feeling, but a different willingness to take risk in a business context. And so on the next slide, I talk about a study that was done to assess this. So in this study, students were asked to choose between a guaranteed $30 reward or a coin flip. And if the coin landed on heads, it was a guaranteed $10 reward. And the coin flip, if the coin landed on heads, they'd win $30. And if it landed on tails, they'd win $0. So the expected value of the coin flip is $15. Now, a rational person should take the coin flip because that 15 is better than the 10. And yet this study was done with Stanford PhD students in finance. And only about half of them took the coin flip. The other half took the guaranteed $10. And the researchers were wondering, why is this? Why is it that the Stanford PhD students in finance are so, irrational, and they're not taking this higher expected value gamble? So what they did then was they tried various techniques to make them more or less rational in this decision. One technique was to show them a face before the decision was made. So they showed them a picture of a happy, smiling face or of a negative, fearful face or an angry face. And then they also showed a few neutral faces. And what they found was when they saw a happy face, they were 30% more likely to take the risk, the coin flip, than if they saw a negative, an angry, or fearful face before the choice. So it appears that this face had a significant effect, and yet no one who was studied believed that the face had any effect. They were asked to label the face as a man or a woman, and that was it. They weren't asked to label it as any emotional quality or to think about it at all related to their decision. And yet it had a profound effect on their decision-making. Now, if you think about the world's largest retailer, Walmart, with their happy face logo, the smiley face was actually decommissioned in the 90s, but brought back a few years ago because it is really a compelling, potentially risk priming type of cue. And it can cause people to potentially take more risk and be more likely to buy products. If you also think about Amazon, the world's largest online retailer, their logo is a bit of a smiley face with a smirk. You can call it a swoosh, but what it really looks like is a bit like a smile. And so there's a logic behind many of these logos that try to promote people to take more risk or to buy more freely products. Contrary to that, of course, there's Genki Sushi. If you've ever seen their logo, it's a frowning face. But in fact, it's so ridiculous that it makes people think it's cute, and maybe in that case more likely to buy as well. So there may be some offsets there. So knowing that there are these biases, the question then is really, what is the effect of these biases publicly? I mean, we've known for 20 years or even 30 years that there are these biases in business decision-making. But I think the question is, what is their effect on actual market prices? Like, is it just something like an interesting trick that we do? Or is it something that actually affects long-term business decisions and pricing and valuations of business? And so in this slide, what you can see are several of those effects that we have. There's a number of them that are, and what we show here are actually their effects on portfolio manager returns. So these are effects from investors, long-term investors. And so you can see, for example, that the largest effect is the distraction effect. It can cost from 500 basis points to 700 basis points per year. And that effect is, when it says PA, that's per annum. So these are annualized interest rate effects. And 500 basis points is 5%. So if you're a portfolio manager and you become very distracted, it can cost you about 5% per year on your performance. So quite a lot, especially when you consider compounding over time. Now, distraction in this case, the most significant distraction, of course, is divorce. That makes people distracted. Also, a sickness of a family member can be very distracting. Also, though, interestingly, positive distractions like marriage are also impacting returns quite a lot. So in the 6 months before marriage, portfolio managers underperform about 500 basis points. And in the 6 months before divorce, about 700 basis points. But then subsequent for the next 2 years, they still have less than 200, or more than minus 2% underperformance for the next 2 years. These distractions, they're major life events and they linger. And so we have to think in our own business decision-making, what is it like, what's likely to be affecting us? Probably these major events are affecting the quality of our decision. And so as we go forward, when we talk about how to pull ourselves out of this or think more clearly in the context of these events, we'll talk about some tools and techniques to do that. But the big picture is there are issues like this, like distraction, what's also called overtrading, which is getting too involved and micromanaging, making fast decisions. That also can be quite detrimental, as you can see in the list. So there are a number of these issues that come up that can be quite detrimental to your decision making. And I'll give you one example here, which is a question. Do you find yourself spending more time on the buy decision or the investment decision in a new idea, or the sell or the exit decision that is leaving an old idea that's gone stale? Now, if you ask yourself that, and when I ask audiences that, most people, in fact, almost everyone, says they spend more time on the new idea, on investing their time or energy in something new. But very few spend their time on the old, on actually thinking about what's already underway and what they should get out of or hedge themselves against. And so you can see in the graphic there that the orange line is the average return of over $1 trillion in portfolio management decisions. And you can see that orange line tends to actually outperform the black line, which is the benchmark. So people tend to do well at first based on their decision making. So new decisions are generally good decisions. But then things can often go wrong. And again, this is portfolio managers in the investment world, but they tend to underperform after a while. And then they get out of their position when they're underperforming. So people tend to stay in, do well at first, and then by the time they get out, things have generally gone wrong. So what the argument here is we need to spend more time thinking about the evolution of our decision making and trying to make sure that we're in a good position and that things are evolving as they should be. And if they're not evolving as they should be, we should get out before it's too late. We should change course. Now, what it turns out when academic researchers have looked at why they exit too late, they find that most portfolio managers are actually reacting to news events or price events that are not actually relevant to their original decision making. So as you know, in business world, when we make a commitment decision, when we invest in something new, we tend to spend time thinking about what we're doing and investing our time and resources and building that out. But then it can fall flat initially. And sometimes when things fall flat, we should wait and give the market time to evolve. As long as it's still in line with what we're expecting, that is, we're thinking that this product is really something that the market wants. Now, another interesting finding from this research, this data-driven research on portfolio managers, is that many of us get distracted and don't focus on the big picture enough. So in this slide, what we see are the returns, the annualized returns from positions in a manager's portfolio, so small investments. And you can see that the more heavily weighted an investment is, the better it performs. Whereas what really drags them down tend to be these smaller positions, these really distractions. What some people call the farm is where they keep small ideas that are maybe not that relevant to their current investment strategy, but the people often keep placeholder positions or this farm of small ideas. And those actually tend to underperform. So what we really want to do is commit ourselves, make big decisions, cut short anything that's small, that's not that interesting, and commit ourselves fully to what is of most value and what is of most excitement right now. And by focusing our attention on those, we have less distraction. And as we saw, distraction is very costly. And we can stay more committed and generally outperform over time. So in the business world, we want to stay committed to the big idea, stay focused on that, and not let little distractions bother us. So we'll talk about a tool related to simplifying in our portfolio of decisions so that we can do better in the longer term. But now we'll take a bit of a deviation to public markets, and we'll look at the media's effect on our returns, both as investors, but also we can imagine there's many parallels here for the business world and for business communications. So Nobel Prize winner Robert Shiller has said that narratives are major drivers of economic events. Now, narratives, of course, are the stories that we tell ourselves. It's stories about what's the next big thing, or stories about what is a bad idea or who's underperforming and why. And these stories can really dramatically influence our behavior over the long term and influence the evolution of events. So we've decided, our company, MarketSpsych, in partnership with Reuters, with Refinitiv, have developed a text analytics tool where we look at themes and sentiments and emotions and try to pull those out of text so that we can identify what are the most influential themes and emotions in text that drive prices. So you can then, for example, understand how do these themes and emotions drive the valuation of a company over time, because we've systematically broken these down over 20 years, the last 20 years, since 1998, in the news and social media. Now, Julia, are you able to click through? There's a lot of animations on this slide. Are you able to click through so they...
I'll certainly try.
Okay, thanks. I'm unfortunately unable to see it entirely here. Right before this presentation, my view of the slides actually broke. So I have tiny little slides I can see, but I can't really read anything on them. Okay, thanks. So we do track, so you can see the headline on that slide is from Luckin Coffee. And as many of you know, Luckin Coffee had a scandal due to fraudulent sales numbers that they've been publishing. And that broke in April 2nd of this year. So we're able to look at a content set like a media release like Luckin Coffee and break down the geographic location it's occurring, the entity like Luckin Coffee that it's occurring to, and then major players in that company like the COO, and the fact that there has been bad management decisions, and there's an investigation, a legal investigation into the management's decision making. And so by breaking that down and turning it into numbers, we actually can create time series. And so we have two time series relevant to this article. We have a sentiment time series that goes very negative on Luckin Coffee. And then we have a management trust time series, which is really a compendium of all the references to the management team, whether they're positive, like the management team winning awards or being acclaimed for their decision-making, reviews in top magazines, or negative, like management scandals. Those, of course, would weigh on the management trust, and that's what we see here in Luckin Coffee. So on the next slide, we actually produce about 140 of these types of indexes, like sentiment or management trust, but we also have others like fear and anger. And so I'll actually show you some results on how public anger affects share prices and how it likely affects us in our own decision-making, and so how to think about those effects. Also, it's important to think about management trust because in the academic literature, we hear a lot about the importance of management teams to driving corporate decision-making and corporate performance. But at the same time, if the management team is untrustworthy, does that affect the price? Does that affect the valuation of the company and its long-term returns? Because there are, many people who say on both sides of the political spectrum that managers these days or government leaders are not trustworthy. And so does that affect the long-term economic performance of the country where that kind of conversation is happening? And that's, of course, of relevance to all of us these days. So we do pull out this type of data from 2,000 global news sources and 800 financial social media sites. And like I said, we have this data back to 1998, so 22 years now of data. We actually cover over 20,000 companies now, and then every major currency and commodity and country. So it's a very comprehensive data set that we're pulling out. So in this next slide, we have the depiction of what management trust looks like. So when we create these data series out of text, we're able to then visually look at management trust over time. And you can see Satya Nadella at Microsoft had very positive management trust throughout 2018 and through 2019. But these were very tumultuous years for Facebook, where there was the Cambridge Analytica scandal due to election interference by Russia in the United States. And then there was also the Elon Musk and Tesla had a number of management scandals related to calling a British cave diver a pedophile or a pedo. And then he also, of course, smoked marijuana on a podcast. And then he was indicted by the SEC for securities manipulation. So he had a pretty bad year. And you can see the drop in his management trust there. Yeah, so that's the management trust. And so that's a depiction of what this data looks like. And this is the data that we produce with Refinitiv called the Refinitiv Market Psych Indices. So we track a lot of different themes over thousands of news and social media sources since 1998. It's a very comprehensive data set, and you can see major events in it. But what's also interesting, besides just seeing the events, is testing it. Again, we're trying to be data-driven in this presentation today and understanding what really influences business valuation over time, what types of decisions and what types of perceptions change how businesses are valued and ultimate shareholder value. So on the big picture is just the overall positive and negative sentiment. And so what I'm showing in this slide is a very general study in which we look at all of the positive references to a company minus all of the negative references to that company, and we take that final score and we call it the overall sentiment. The companies that have the most positive sentiment in a given month were then ranked in the top decile, and then we ranked all the companies in the United States since 2006 based on their ranking of sentiment in the media expressed about the company. Now, in the green lines, we have the most positive companies, and in the red lines, we have the most negative companies. What we did was after we ranked them for the prior month, we tracked their performance in the stock market over the next 100+ days. And you can see that the green ones, the ones that were most positively perceived in the media in the prior month, outperformed over the next period of time. And this was done with 5,000 US stocks, point in time. So we went back to those that were in the top 3,000 starting in 2006. And we rolled this forward year after year. So for over 15 years now, we've been tracking how this performs, and it does very well. The spread exists over thousands of stocks. And it's actually a nice, consistent enough spread that we were able to build a new product on top of it called the StarMine Market Psych Media Sentiment Model. It's a bit of a mouthful. But that StarMine product is predictive of the next 30 days, and we launched that earlier this year in January. And that product itself has had a very nice return this year, quite a high return, even bigger than what you see here. It's about more than double what you see here because we use some machine learning to find the most important themes and emotions that drive stock prices. So even beyond this particular Refinitiv Market Psych Indices data set, we've been able to combine the best elements of it into a model called the StarMine Media Sentiment Model. And so that model itself is showing excellent predictive power, both in the historical construction of the model, but also in the forward testing. And that's a once-a-day score for every U.S. company that shows, based on the past media, how their stock price is likely to perform going forward. So over the next 30+ days. So that's been quite an interesting experiment, and we're very pleased that it's been outperforming so well recently. Now, the next slide shows a depiction of, again, back to management trust. This is a depiction of Luckin Coffee. So I showed the examples of Tesla, but I didn't show you the stock prices of Tesla and Facebook at the time. Luckin Coffee and Wirecard were a couple scandals from this year. And you can see in our Refinitiv Market Psych Indices data that a surge in the litigation index about Luckin Coffee and a drop in the management trust seemed to precede a fall in the price of Luckin Coffee itself. And again, we saw the same thing with Wirecard, that the data, the media itself was predicting a problem at these companies. Litigation was high, and management trust had fallen quite a bit before the major sell-offs in their share prices. So there is an interesting correlation here, and we talked about sentiment. Now we'll look at a quantitative study on management trust, I believe. On the management trust side, so what you see here is on a given day, if there's media about how great the management team is or how horrible they are, we plotted the returns over the next day, and then we created a portfolio so you could actually track these over time and see the spread. So what you see is when a company is consistently praised as having an excellent management team, that over time their stock price does outperform the companies that are consistently criticized for their poor management. And so that's quite a spread. That's over many years since 2006, but it does show a lingering effect from the media. And part of what the bias is here is that leadership and the perceptions of leadership affect how we value a company or how we value potentially a country and its economy. So it's key that we have a strong perceptions of leadership and competent perceptions of leadership if we want to have high performance in our own business. And whether it's our own leadership perceptions, how people perceive us as a leader, or our company itself and the managers we work with, it's really key that we keep a strong leadership perception. Now you can see in the next slide, this is anger at companies. So this is public anger in the media. And what we find is that companies that have the highest public anger expressed towards them underperform over time. So just like low management trust underperforms, same with high media or high public anger at a company. So if your company is subject to public anger, if you're disappointing your customers, for example, receiving anger about your products or your customer service, or anger about decisions made at the company, poor management decisions, all of these can create anger. Also, social perceptions. For example, Papa John's Pizza was very high in our anger index for quite a while. But they, interestingly, did a lot to change their management team. And within a few months of their racism scandal, had suddenly actually started popping up as a higher management trust company because they got rid of many of their older managers and hired many new, more diverse managers. And so suddenly have outperformed quite tremendously. And then, of course, with the pandemic, they did very well with pizza delivery. But they actually, within about 6 months of their scandal with their former CEO and chairman made racist comments, they launched a vegan pizza in the UK, for example, and became awarded by the Vegan Society of the UK as being a very innovative, supportive group. And all around the world were doing very innovative and socially conscious activities, which would have been lost in that public anger, but then the public anger started to turn. So this can be turned around. And one way to think about this is we tend to underperform in general when we're angry and when people target us with anger. It's very distracting. And as I mentioned about distractions, that's a problem. So we want to keep things obviously always above board. And when there's any anger or any flaw, we need to address it directly and head on, address it immediately. And this doesn't mean addressing it that, we don't know what's happening, we'll look into it. We're going to look into it and we're going to fix this. That's the type of addressing it that we need to do as business people. It's not something that needs to be simply acknowledged and moved on, but acknowledged and addressed, and that we will work to solve this problem. Now, we can also, using our visualization tools in the icon, which is the Refinitiv icon workspace, we can show how companies are perceived in heat maps or charts, as you've been seeing in this presentation. So these charts actually come from the Refinitiv icon, where you can, for free, see this data set and plot your own company or competitors and see how they are performing on these various metrics. So in this heat map, what we see is back in October, we ranked companies based on their management trust level. And the green companies have the highest management trust, and the red ones have some of the lower management trust rankings. The size of the box is the amount of buzz in the media about that company. So you can see some of the green companies here are likely to outperform according to this type of data set, and then the red companies generally underperform. At the extreme levels where there's a lot of buzz, things aren't as consistent, but when you look at thousands of companies, it's quite a consistent pattern. So now we'll talk a bit about a different pattern we see, which creates a different type of bias. So in the markets, we also have this phenomenon of overreaction or V-shaped bottoms, like we saw with coronavirus, where there was a period of uncertainty, then a period of fear, then a panic, and then suddenly a giant bounce and a complete recovery in the financial markets. Now, not necessarily in the business world, but certainly in the financial markets. Now, some of the wealthiest investors in history, Munehisa Hanma, who is said to be the wealthiest person alive at his time in Tokyo, or in Japan, and then Warren Buffett, of course, who's occasionally ranked as the world's wealthiest private individual. They've both said that it's good to buy on fear. And yet to buy on fear or to invest in something where everyone else is worried is a bit counterintuitive to what I've already said. But keep in mind, fear is risk perception. It's not necessarily the same as anger or management trust, which are more fundamental to a company. Fear is more about what we perceive to be the danger. And as I showed in that brain slide at the beginning, sometimes when we perceive danger, we lose the ability to take opportunities. We lose the ability to actually even perceive that there could be an opportunity. So we need to consider that bias in ourselves, that when we are very scared, we should think about, well, I might be overreacting, I might be overestimating the danger here, and there might actually be an opportunity to turn this around. And obviously, the classic example recently is the coronavirus situation. And so what I've plotted here is a depiction of the S&P 500. Now, the yellow bars underneath it are the prevalence of human infectious disease references in the media about China and the US. And then we have two moving averages below there of different types of sentiment. First is fear. So as fear rises, we put red shading between the two lines, and then as fear falls, there's green shading. And you can see that fear started falling right around the time of the bottom of the stock market. And then sentiment started rising just after the bottom. So sentiment turned a bit more positive. And what we find when we look at historical epidemics and major events that are uncertain and unknown, like epidemics, is that when fear starts to fall and sentiment starts to rise or become more positive, prices tend to revert. So if you're wondering how to time this type of fearful situation, you want to wait until fear has plateaued or the news is not getting any worse. And that's when it's time to jump and take the opportunity to help turn things around, because then the participants in your business or in the markets will be ready to hear your positive story and ready to take action to make things better. So now we'll talk a bit about yourself and your own mind and how we can work with these types of biases to improve our decision-making. And just a moment. I can't read those slides, so I'm just going to very quickly pop these up on my screen. Okay, so in terms of managing the biases, the key thing is to take control of your attention. So many people are using meditation these days to be able to maintain control of where they focus their attention. Obviously, there's so many distractions, and we live in an attention economy where many of the newest businesses that are most successful capture our attention, like Facebook. Just as the media like television used to do, or radio, now it's social interactions like through Facebook that capture our attention, or Google and the rabbit holes that we can go down reading different types of shocking or jaw-dropping news events. There's always an incentive when we look at free media for that media to play on our vulnerabilities of attention and pull us deeper and deeper into these what we call rabbit holes of attention. So remember, your attention is yours, and we don't want others to monetize it. We want to keep it for ourselves because it's extraordinarily valuable. It is our life in many ways. So take control of your attention. Watch out for the distractions that can catch us, like life events, which many times we can't prevent, but we can try to compartmentalize in some way. If we find ourselves during the day at work worrying about something external, we can actually schedule a time to worry. And we can tell ourselves, look, I will worry about that at 4 p.m. And I'm going to put this in my calendar that I will worry about this issue at 4 p.m. But right now, during the day, I'm going to do what I need to do. And I'm going to try to make the best decisions I can. So literally, many people that I've worked with can schedule in their calendar a time to worry and then fill that time with everything they need to worry about. And what they'll find is actually by the time they get there, they're not that interested in worrying about those things anymore. When you approach it rationally, worry tends to dissipate. We can also focus on our process. So too often we focus on the outcomes of our decisions. And there's a great new book by Annie Duke about called, I believe, How We Decide or How to Decide, which describes really the key to making good decisions is to focus on our process and our expected value of various types of outcomes, rather than focusing on the mistakes that we've made in the past or good outcomes that we've had. It's not always about the outcome. It's about the process of decision-making and having a coherent, clear process. That prevents a lot of these distractions and biases from interfering with us. It's also important that to have such a process, we need to be curious about the mistakes that we make and also about the mistakes and opportunities that we've missed. So it's really easy to look back at our mistakes and feel bad about them, but that doesn't help anything. It's a lot more difficult to look at opportunities that we've missed. That will train us to take action when we need to take action in the future. And in fact, we at MarketSpsych, we've had a personality test online for over 16 years now, which is a free financial personality test. And many people in the business world have taken that test, about 30,000. And we've found that the key predictor of success is making decisions quickly, especially in the investment world, but that extrapolates somewhat to the business world. And making key decisions quickly is important to capturing the initiative. If we wait too long, then we're just a follower. And it turns out that in other research in academia, herding behavior tends not to work out well. So we don't want to follow what others are doing. We want to be original, and we need to act quickly sometimes to capture the initiative. And then lastly, we want to differentiate emotion-driven versus fundamentally driven decision-making. So sometimes we'll decide out of fear, but as we saw with Warren Buffett and coronavirus, we don't want to make rash decisions based on fear. We instead want to wait until that fear is dissipating and then think rationally about what to do. Also, when we're deciding out of anger, we do want to say, look, anger is a bad thing for our company if people are angry at us. And we want to dissipate that anger quickly by addressing it head on. People who are angry tend to be very certain that there's a problem with you and your company. So we want to make sure that we address that directly and try to help mitigate that anger very quickly. Now, the next slide is about managing your mental state. So let me turn to that slide. So for this slide, there are, again, a number of goals and techniques we can use. There are learning goals. So think about in your own work, what are you curious about? What can you improve? And how can you become better? So there's no one-size-fits-all solution for us to improve our work, but rather we have to become curious in ourselves. What do we notice is valuable and important for us? How can we become better in what we do? Secondly, meditation has been found by many people to be very important for letting go of distractions and maintaining our focus and keeping control of our attention so we don't go down those rabbit holes. Thirdly, as I showed with that slide on focusing on our high commitment decisions, we need to look at what's most important to us and focus heavily on that. And everything else that's a little bit less important or small importance, erase that from your calendar. Get that off your calendar because you don't want those distractions. They take away from your ability to really capitalize on the biggest and most important decisions you're making. Then there's a technique, there's two techniques that have been proven by literature, by academic studies. One is called the best possible self. So most of us brush our teeth in the morning, and I think all of us do. And if we didn't, our colleagues wouldn't want to be around us. Really, things wouldn't work out well at work. But very few of us do mental hygiene in the morning. And mental hygiene can be as little as 30 seconds of just imagining who you want to be and how great you want to be in a given day. So practicing mental hygiene and thinking about who you are at your best. How can you be at your best today? Imagining that And if you have trouble with yourself, imagining a role model in that position, that can be very helpful for improving your day. And in fact, studies show that that increases lifetime earnings and lifetime satisfaction. So imagining every morning for, say, 30 seconds or 2 minutes, who you are and will be at your best today, how you'll tackle challenges at your best, that improves your life significantly. It's a very small practice. And again, if you're going to spend a minute brushing your teeth, you might as well spend a minute on imagining your best possible self. And then lastly is a gratitude list. And there's a lot of information online about these. They're really quite effective, and you can look that up. This is quite good as well. So I will wrap it up now with a bit of Q&A in case we have any questions. I would say that there are a few email addresses that don't appear on this slide. You could reach out to info@marketpsychdata.com if you'd like more information about our data products here. Also, Refinitiv, of course, you can reach out to Julia if you have any questions about how to use this type of data or trial this data. We do have free trials available if you'd like to test this data for your own strategies or your own business decision making. So we look forward to hearing from you, and I will wrap it up now. Okay, thank you very much for your time.
Thanks, Dr. Peterson.
So one question that we often get about this data product is whether news or social media tends to be more influential. You know, most people tend to see that social media is more of a distraction. But actually, with data derived from media, we find that social media is actually more predictive than the news media. News media tends to be a bit late. And social media actually is quite valuable. They're both valuable, but social media has really unique value that we see. So I just wanted to put that out there quickly.
So far, we've just heard that this is great content, and they thank you. So always good to have positive feedback.
Well, certainly, you know, this is a very wide-ranging presentation, and in the business world, there's a lot that we have to focus on and juggle. So if you can take away one thing from this presentation, it's one of those managing your mental state techniques. If there's anything you can do, a gratitude list in the morning or imagining your best possible self in the morning, those exercises are small, but they're research proven to improve your life and your life satisfaction and even your income. So I would recommend just something as small as trying one of those techniques for a week at a time can really improve your life. Or meditation, something like that. There's a lot of really neat things out there. So the other thing that we like to talk about is you know, data-driven results. There's been for 20 years, part of the reason I became a psychiatrist was because I felt like psychology was so anecdotal and vague, and that at least in psychiatry, through going through medicine, I would get more of a data-driven biological approach. And we did, but now actually psychology has become very empirical. And there's a lot of great stuff coming out in positive psychology. So I encourage you to look into some of the books that are out there on positive psychology if you're interested in this content. And again, on the data side, do reach out to us because we are learning a lot of insights about how markets work, how the business world values companies based on this data set. But thanks. We all have a tough job out there in these times. So good luck with everything, and I wish you the best.
Thank you again, Dr. Peterson. And, you know, if anyone has any additional questions following this presentation, please feel free to reach out to either the email addresses Dr. Peterson had provided, but also remember that you can download these slides under the resources section. So you can refer back to them and use them on a daily basis. Looks like we did just get one quick question. So Lydia would like to know if, Dr. Peterson, I am actually interested in this as well. Can you recommend any books on this topic or just in general on business biases and how
there's
the data affects that?
There's a variety of books, and it's a great question. So it depends on the level that you want to go into this. So a very general book that's is pretty fun to read is Tools of Titans by Tim Ferriss. He's the author of the 4-Hour Work Week, for example. It's an interview with a number of people who have been successful in business and other fields, and then kind of tools and techniques that they use. So that's very general. Then there's more focused is Principles by Ray Dalio, which of course is which is pretty dense and can be kind of overwhelming, actually. But that's quite a useful book as well, very large, though. And then there are books like Thinking Fast and Slow by Daniel Kahneman, the Nobel Prize winner. It's considered a classic. It's hard to apply it all to business. So there's no single book that I have found that really bridges all of these biases and business in a very useful way, unfortunately. I haven't been able to find that. So I did write a book in 2010 with my partner Frank Murtha called Market Psych, which is for investors. And it's fairly broad, general reading. And it's for investors to work with their biases, but it's not specific to business. It's not broad enough for business in general. I would also say Kelly McGonigal has some great books. There's some books like Grit and Mindset that are quite good. But again, each one has a bit of its own focus. So there's nothing broad in general for the general reader that I've found, I'm afraid.
Well, sometimes specific is better. So looking forward to adding those to my reading list.
Yeah, some of them are pretty dense. So.
Thanks for the warning. No other questions have come in. So again, please feel free to reach out. We're happy to continue the conversation offline. And don't forget to download the slides to refer back to them. And Dr. Peterson, thank you so much for your time. I certainly learned a lot today.
Thanks, Julia. I wish you all the best.